Hello there, this is James, and I'm one of the sales managers here at FXPRIMUS. And thank you and welcome for joining our latest episode of our Primus Live webinar series. Now, before I get started, remember, these live broadcasts are for educational purposes only, and in no way whatsoever should ever be taken as advice. I always suggest you do your own research and do your own due diligence and know the risks at hand before entering any trade. Now, let me introduce you to my co-host. And before I do that, let me give you a little introduction on how special this individual is. Now, Kaya is our senior market analyst here at FXPRIMUS, and she has worked as a portfolio, easy for me to say, an investment manager with both the public and private markets. Before joining us, she was an associate at a hedge fund in Singapore and a vice president at the Bank of America, Merrill Lynch. Welcome, Kaya.
Hi, James. Good to be here, and thank you for the intro. How's your day?
Not bad at all, and it's a pleasure, absolute pleasure having you. My day's been okay. It's been a Tuesday. It's been a funny old day, but most days nowadays are quite funny. How about yourself, my love? How's your day been?
There's no such thing as routine in 2020, so I'm just going to echo what you said. There's no usual or common days these days. Everything is a bit special, so pushing it through.
That is very, very, very true, and we can only do the best we can, and we soldier on, so to speak. So today, this is obviously episode 2 of our special Primus Live webinar series. Last week, we did an introduction on technical analysis, like a brief introduction, which we'll do a lot more on. But today, especially with something exciting happening in the early weeks of November, we decided to go on to fundamental analysis. Isn't that right?
Yeah, super excited to do the second series of our financial analysis sort of series. Last time we spoke about technicals. We got really good feedback from everyone. So who hasn't seen that video yet, please go to our YouTube page, find that one. But today we're going to focus on fundamentals. And this is super important because, like James mentioned, we have upcoming US elections next week. So we want to talk about the sort of economic factors that everybody should keep an eye on, and then how politics actually plays a role in all this.
Absolutely. Absolutely. So let's get started. Take it away.
Let's get started. Fundamental analysis. What is fundamental analysis? To start with, it's a definition, a financial analysis that uses economic, social, and political factors to determine the price of an asset. Now, today we're going to focus predominantly on forex markets and what really drives the price of a currency. So there are a few factors. We're going to talk about interest rates. We're going to talk about inflation. We're going to talk about GDP, or gross domestic product. And we're going to touch very lightly on current account and some other economic variables that may change, from country to country. So with that done, let's start with interest rates first. Interest rates really are considered as the sort of price of a currency. And this is determined by the central bank of a country. So in the US, you have the Federal Reserve Bank of the US. In Europe, we have something called the ECB. You have the Bank of Japan. And they are a group of really, really smart guys or women who come together and they sort of look, how's our economy doing at the moment? Like, do we need to have higher interest rates to sort of curb the lending activity? Or do we need to lower the interest rates to sort of promote the lending activity and economic activity in the country?
That's right. Because there's two things they tend to do, isn't it? There's first of all, is loosening, is when they tend to reduce interest rates to try and encourage people to borrow and spend their money. They do this usually when there's times of economic slowdown and things like that. Like we've seen really since the financial crisis, since 2008. And then you have the other side of it, which is called tightening. And this is when the economy is performing quite well. They raise interest rates to try and encourage people to save. Isn't that right?
That's 100% right, James. And we talk these days in some jurisdictions, let's say maybe 6 months ago, we spoke about tightening in the US, right? So we got to the highest, I think 10-year rate was maybe 2.85%, which is a joke compared to 1980s when we saw 17% interest rates. So we'll see if our generation is yet to see such high interest rates. But in general, what high rates tend to do is that they tend to attract investment into that country. Let's say you have somebody in a country that has 0% as an extreme example, and then the other country where you can earn 17%. So of course there's a sort of tendency to invest in that particular country with higher interest rates.
Absolutely, you actually hit the nail on the head there, because it's one of the attractions of higher interest rates is obviously foreign investment. Because, like you rightfully say, it makes more sense, putting your money in a country with a higher interest rate than the existing country you're with. But I think that's what a lot of the central banks try and strive for. Because as soon as you get foreign investment, that is obviously a big positive for your economy. So I think you're absolutely spot on with that. Absolutely.
Yeah, and we are at the moment in a very interesting sort of monetary test period, doing negative interest rates. So the world has never seen this before, at least, not within the recent history of 200 years. Maybe in some other localized environments back in the day, there was negative interest rates as such. But these days, there are actually three countries that have negative interest rates, Denmark, Japan, Switzerland. And now, how is this going to impact the value of the currency? These three countries, or at least two of these countries, are very stable, big economies. So the negative interest rate actually doesn't even impact the value of the currency that much. So it's an interesting experiment we're going through. We'll see how that's going to end up.
Absolutely. What's the next fundamental or economic indicator we want to discuss?
The sort of flow from interest rate goes into inflation. Inflation is basically steady increase in prices of goods and services. And economic growth tends to go hand in hand with a bit of inflation, meaning if economy is doing well, you sort of expect prices to increase on a gradual basis because people earn more money, they get higher wages, they're willing to pay more for certain services, and therefore also the price of that service tends to increase. So most developed countries have established 2% inflation rate as a sort of target rate. But again, as we have seen in the recent history, maybe last 10 to 13 years, inflation tends to be extremely low. In fact, in some jurisdictions, in some regions, I should say, in Europe as a whole, we see deflation, which is negative inflation.
There was I think it's like people tend to measure. It's consumer price index is a good way of obviously measuring inflation, because obviously that measures the price of a basket of goods. The other thing what people look for, like the CPI and consumer price index, is there's one of the ways when you get your inflation is high and you battle it, you're trying to keep it down, is raise interest rates. I can name you one recent example was in the UK, and we'll talk about that with our political section. With all the downward of the sterling back then after Brexit, prices of certain things in the UK went up and inflation went up. And as you rightly said, most central banks try and keep a target rate of 2%. And the UK's inflation rate was skyrocketing at this point. And the Bank of England had to go and had to do something. So there was a lot of chitter-chatter, a lot of talk about them raising interest rates to combat it. So this is something else, which is like it's like an early warning indicator. They might do so with interest rates, don't you think?
100%, and inflation is extremely closely monitored by central banks. So in the US, central bank actually has two mandates. One of them is making sure there's full employment, and secondly, making sure that the consumer prices are kept sort of in control. So inflation, definitely their number one, data point to monitor. But what's interesting, James, is that inflation actually it differs from person to person, and it differs from article to article. So I'll give you an example, like in the US, within the last 20 years, you've seen a huge inflation when it comes to education and when it comes to certain, let's say, real estate. But when you talk about goods that are produced in Asia or let's say in low-cost environments, such as maybe TVs or some technology, it's actually deflation. So consumer CPI actually takes an average of these two extremes. So people perceive inflation in a very different way.
Absolutely. No, it's a very, very valid point. Very valid point. So inflation, another key thing to watch. What's the next thing to watch? Aha, of course.
Aha, next we're going to talk about GDP. GDP is effectively the monetary value of all the goods and services produced in a country. And it's a total economic value that a country produces. And again, it's a very important data point because it actually shows if a country is able to expand its monetary base in a way, but also the economic value. And investors always look for countries where they see growth. Nobody wants to invest in a country where you see GDP is down 10%. It means on a collective basis, the investments are also going to be down. So investors always keep an eye on those countries where you see growth with reasonable interest rate, with reasonable inflation. And when I say reasonable, it's because it again differs from investor to investor. But central bankers also keep an eye on GDP a lot. And what we are seeing with this recent COVID crisis is historical plummeting of GDP growth rates. Yeah. So it's actually contracting. US was down 31% last quarter, annualized basis, obviously. So it's really historical times we're living.
Very much so. Yeah. So, but say, really with these times we're living in, incredible times. But yeah, to say gross domestic product, the way I always see it is you sort of basically measuring the overall health of a country's economy, how healthy it is, and how well it's going to perform and growth. And though when it comes to currencies, what I tend to find is that it can greatly move the market, but there's a lot of time people try and look to see what the GDP may be next time around, forward guidance type thing, trying to be predict where the market may go. But yeah, it is like a health monitor.
Sure, and with GDP as well as with inflation, you're going to have an impact on currency if the actual number differs from expectation.
Absolutely.
So, before any economic announcement, there's always some sort of market consensus, or we expect GDP to be up X% and inflation to be X%. If the sort of actual number meets expectation, there's no volatility. It's just all good, just happened. But if you see a large deviation from that expectation, then when you're going to see those movements happening. And those traders who are contrarians or who have like differing views from consensus, they actually bet on that. They think that, okay, ECB is saying we're going to have 0.1% inflation. No way. I think there's going to be deflation. They can place their trades around that.
Absolutely. If it's a shocker, the market will most likely, pay attention to it, so to speak. Moving on to the next bit. What's our next bit? Take it away.
Next bit, we're going to have quite a few on one slide or on one sort of data points put together. I want to talk a little bit about current account. Current account doesn't get that much attention, I think, on news and on the media, but it's actually very important because current account is something that's basically the difference between imports and exports for a country. And if you have a large current account deficit, it means that you are buying more than you can actually sort of export, because exporting means you earn money. Importing means you have to pay money. Great example. Let's draw the most obvious example is China and the US. China produces a lot. The world is they're basically the world's production center or manufacturing center, and US buys a lot from China. So US happens to have a huge current account deficit. China happens to have huge current account surplus, and they sort of match together. And this is the whole reason why the US has started this whole trade war, because they feel that China should also be buying more from them. So there's a bit of like natural tendency for them to be linked from hip, but the US is not super happy about that because they feel that China should also contribute towards their economy.
Absolutely. Like I say, but they like competing, don't they? Plus, I also think the Americans are looking over their shoulder thinking, hello, we have somebody challenging our title as the number one 100%. Economy. Absolutely.
Yeah. But at the same time, why US benefits is that there's a demand for their dollars, right? So basically what China does is they're accumulating the dollars. So.
Well, it is the world's biggest reserve currency, and will be for quite some time. The next one we have is retail sales, which I think is something I do watch. Okay, a bit, but I think you rightly pointed out when we had this conversation before we went live, it only tends to be two sort of countries or two economies which tend to react to retail sales, which I believe is the United States and obviously where I'm from originally, United Kingdom. What do you have to say about that? What do you feel about that?
100% right. I mean, different economies consist of different components. For US GDP, it's 70% of consumer spending. So clearly retail sale is a huge driver. And the same for UK. I don't know the percentage wise. I think it's around maybe 40, 50, but it's still huge. Whereas let's say for Australia, it's industrial production that's much more important. So whatever we say in this webinar, you have to apply in the context of that particular country and that particular currency.
Absolutely, absolutely. And the thing is, what I always look about with the retail sales, because certainly the as you rightly said, 70% of consumer spending in the United States is from retails, because a lot of the modern economies, certainly for the United States and certainly for the UK, relies on us buying stuff. You know, the latest iPhones, the latest Samsungs, the latest computer games, the latest whatever your pleasure is. They need to spend our money to put obviously the money back in the system and so on and so on. So I'm always fascinated by watching retail sales, certainly when I'm trading over the cable in particular. You know, so that is something I do pay attention. But you're right, you do need to put whatever economic indicator in contents to the economy or the currency you are trading. Because like you say, not everything has an impact with all the other countries like it would do maybe in particular currencies or particular countries, etc.
Yeah, and very important point, something I mentioned during this week's 1 Minute with Kaya was, maybe it was last week, apologies for that, that there's a bit of like a feedback loop also with retail sales. Let's say if a country also produces a certain article and you have a high retail sales, that tends to trickle back, meaning if high retail sale means you're going to have high industrial production most likely. So these things are all sort of linked with each other. So retail sales is not completely separate from industrial production. But of course, these days, we tend to outsource and buy so much from abroad that maybe the linkage has gotten slightly weaker.
Absolutely. Absolutely. Totally right. And the next one is obviously jobless numbers and employment.
Yeah, that's the most obvious one, I think, meaning that the less people you have in the workforce, the lower is your GDP, and most likely the weaker is going to be your currency. 2020 is a very exceptional year again, given the ridiculous number of people out of work. We have to wait for a bit for the numbers to normalize so we can actually draw some sort of conclusions where we're going to head, where we're heading in the US, for instance. I think US is slightly improving, but still far from being healthy. Europe is a bit different animal because there's so many subsidies and all sorts of payroll protection programs here that people haven't been laid off to a such large extent. But if you see a huge swing in jobless numbers, definitely going to have an impact on the currency as well.
Totally. I mean, one of the big ones here for job data, of course, is the non-farm payroll, which is the US non-farm payroll, which certainly for currencies, it was certainly back in the day, used to be a huge market mover for currencies. It doesn't, let's see if you agree with me on this, over the recent years, apart from obviously the dramatic number we had way back in April, it has an impact, but doesn't have a gigantic impact like it used to.
It doesn't anymore. I think the markets have just become a bit numb when it comes to jobless numbers, because it's the same thing we mentioned, I think, our last webinar, that, bad news has become good news. So if you see a huge number of people out of work, you sort of assume that, the Fed knows that the jobs market is out of balance. They're going to rush in, they're going to inject a lot of stimulus into the economy. And then the markets tend to rally, which is just bizarre, but that's the world we live in these days. But I agree, like jobless numbers is not getting that much attention these days. And moreover, coming to more technical point, the Fed actually has denounced using the Phillips curve for their economic analysis. And Phillips curve is basically the correlation between inflation rate and jobless numbers. The link has completely broken down in the last 10 years. So the Fed is basically saying, we're not going to use Phillips curve going forward, meaning they are not going to focus that much on the NFP numbers as such. They're going to look employment on a sort of a broad basis, meaning like the public, the private, everything has to be full employment. Then they're going to consider raising the rates again.
Yeah. Well, like like I say, I think you hit the nail on the head again by saying the market has got a little bit numb. It's still important to watch by all means, isn't it? It's still something to take into consideration when trading. An NFP can still have surprises. And
it can have surprises, and
absolutely.
And everything should be looked as a sort of as a cohesive group. You can't pull out one data point and say this is the most important. No. If the world was that easy, we've had this discussion, we would be all on the beach having a cocktail.
Absolutely. They'd be looking at an empty chair and an empty studio. And I also think at the same time, though, when it comes to some of these economic indicators, it depends what the story the market is focusing on at that time. I'll go back to the instance I was talking about the UK with the inflation. And this was back in 2017 it was. The story at the day was all about inflation. They talked about UK inflation. So CPI took center stage. The jobless claims or unemployment didn't matter. But then the next week or next month, another story could then be about unemployment. So things like the NFP becomes important, or initial claims becomes more important, and so on and so on. So it does really, at the same time, depend on what I think the story of the day is, what the market is focusing on. Because it can only really tend to focus at one story at a time. So I think that comes in. The final one is industrial production and PMI data.
Yeah, we're going to touch on this very lightly. So as I mentioned, different GDPs are composed of different elements. So industrial production is important for some countries, less for some others. For instance, for China, industrial production is paramount. They are manufacturing economy. The moment you see good industrial production numbers, you're going to see some sort of pickup in renminbi or yuan, depends how you look at it. And the PMI data, being the purchasing manager index, is also an indicator where the economy is heading. So it's more like a bit of a leading indicator from that perspective. Has less impact, but nevertheless, we should still keep an eye on that.
Absolutely. Well, okay, I think there's a little introduction to some of the key economic indicators, which, are fundamental analysis, certainly when it comes to currencies. Let's move on to our final slide, which, of course, I think everybody's looking forward to, sort of traders are looking forward to. We're going to talk about it now, and that's obviously the impact of politics on the markets. Bear in mind, we have a certain election. I don't know if you heard about it. It's coming up soon. We have election going on.
We have a big one coming, of course. The one event that has been driving the markets for the last 4 weeks. We've mentioned this during our previous webinars. We mentioned this on our newsletters on 1 Minute with Kaya, meaning everything at this point is driven by the news flow coming from the elections. So the importance of politics has increased with time, right? And I think it's a function of a few things. First of all, it's having access to media, meaning like with all the smartphones we have and access to internet, you have this constant news flow. So of course, you're going to take all those data points into consideration and, trade based on that. But I think it's also coming to the point that we are reaching an end of a global trend. That's a bit of a tongue twister there, of globalization. So I think most people can agree that their home nations have become more inwards. They are more focusing on the benefit of their own country. So make America great again, keep America great, whatever the slogans here and there. So it's a polarization, nationalization, deglobalization that's happening in the world. And with that, politics has become very important because those people who actually run the countries now, let's say the Donald Trumps and maybe the Boris Johnsons, they really have an impact on the politics, through that on the markets, and through that on currency markets.
Yeah, I think politics has always been quite important for obviously traders, because it clearly, it's understandable. A change in government means a change in monetary policy, which can then have an impact on the markets. But I tend to think really it's from 2016, it's been such a dramatic, politics have really got heavily involved in the markets. And we're going to show a few examples in a little while, because there's surprises. Over the last couple of years, what we thought was a dead cert hasn't been a dead cert. It's been a complete opposite, and it's shocked us. And I think, rightfully said, that the world is changing in that sort of way. People, like you rightfully said, make America great again. Looking after your own type thing. And I think this is why politics has become such a key player and a key thing to watch. Certainly, as you're looking for trading opportunities.
Of course, elections are clearly the key event that drives the long-term policy, long-term change, right? So once you have one party in power, you would expect that all 4 years it's going to be like sort of smooth sailing, but not these days.
No.
You open the news, you open your Twitter, your Facebook, whatever. Constantly something's happening, especially with the recent 4 years. I think it has reached its peak, and I think also people are becoming a bit fatigued about that. How much can you actually consume of this? So again, it's a numbness I find that people are showing. Yeah,
eventually people get a little bit tired of it. It's the it's fatigue. It's the fatigue syndrome. But should we have a quick go on the charts and have a look at some examples of some key political events? Which
James, show us some charts.
Major marks. Right. Okay. So
your charts as well.
Yeah, I've got my charts just come up now. Okay. So let's look at one first. I'm going to look at the cable, and you've guessed it. This was the Brexit vote, which I think 2016 was such a strange year because nobody expected the vote to go the way it did. And it didn't go the way it completely blew people's minds. And you can see that this is exactly when the vote or result of the vote happened. The absolute drop the cable went on that day. It's really dramatic. And you can see,
James, it's one of those events that I remember precisely where I was the moment they announced that has been approved. It was like such a shock, like what is going on?
Yeah, I remember too, to my horror, to be fair. I'm not going to tell you my opinion. You can guess my opinion by saying the horror of it, so you can guess how I feel about it. But you can see that whole event here on the chart here, absolute collapsed, and it carried on collapsing. I can even remember the flash crash we had as well, October afterwards, and he went down even. So dramatic. So the cable really suffered. But like I say, that announcement, or that result, shall I say, really impacted the cable, or the sterling in particular. Another example I want to show is this one here. This is the euro dollar. Again, this is an election. This is Macron's election win back in April 2017. And as you can see, the day after, because it was over the weekend the election was done, the day after, the market actually opened with a gap, and the euro then carried on moving higher.
Yeah, just imagine like one of the most traded currency pairs, if not the most traded currency pair, euro dollar, opening with a gap.
Yeah. But it also changed, it completely changed its direction as well. And because I remember that time as well, because again, there was this populist vote thing. They were worried that more people like Donald Trump would get into Europe, because you had the Dutch elections happening at the same time. I can't remember. Can you remember her name now? I can't remember her name. The young lady that Macron was up against in the French election, she was anti-EU as well. So there was a lot of fear that if she got in, then France would do their similar sort of thing to the Brexit and maybe leave. Macron's very pro-EU, obviously. So he won, and the impact was, as we saw, Le Pen. You got it. I couldn't remember her name. Oh, you cheated. You little cheat. Well, fair. At least it's Le Pen. At least we got the name. We got the name. There we go.
Le Pen,
we got the name. Yeah, phew. Le Pen was really anti-EU, and obviously Macron was very pro-EU. So obviously the euro was under a bit of strain. But as soon as he won, there was like a sigh of relief. Like phew, And obviously then we saw a lot of euro strength with that.
I guess you can draw the same parallel with various elections that have happened in Europe, right? So I mean,
absolutely.
Honestly, the euro has gone through so many crises the last 10 years. It's the Greece crisis, the Italy crisis, France having the elections. So, and I think we're going to continue seeing this going forward.
Totally. I mean, I can't remember the exact date, so I can't show it on my chart. but I remember the German elections a little while back as well, which was a Hun parliament, and that impacted the euro. Euro obviously came under pressure after that announcement, because obviously Germany is the #1 economy in the EU and in the Eurozone, etc. So that had an impact. The final one I want to look at, and this this is really what we're building up to coming up, a small, tiny little election. Nobody might know about it. It's happening soon. And this is, again, 2016. Again, in my opinion, a big surprise. And this is gold. Gold on the back of a surprised Donald Trump presidential win. And this here, I mean, initially when the vote came in, it spiked up higher. And then after that, boom, we had dollar strength across the board there. And it actually, in fact, went on a big bull run. And I think the bull run only really ended, the dollar bull run that was, only really ended in January. So for 2 months, you saw a lot of dollar strength. And that was a very dramatic drop, purely based upon, obviously, Donald Trump winning the election. Because I think the market saw it as his election pledges, like tax breaks and tax cuts, these sort of things, and that's how it erected. But it wasn't just gold. If we can, I can show the example in the euro as well. Here we go. Euro did the same thing here, as you can see, a lot of dollar strength on the back of Donald Trump's surprise election victory. So I think that really illustrates how politics can really potentially move the market.
100%, and you're using really dramatic examples here, such as the elections, right? I mean, if we really wanted to show the micro impact, we can just pull out Donald Trump's Twitter feed, see his most notorious tweets, and look at the currency. Let's I don't know, euro, dollar, or whatever. But we're not going to do it today. We can do it some other time. But but it definitely moves the markets, 100%.
It does. Actually, I think I can find one if I can remember the date. I think this one here. Okay, this is not dramatic as the ones I've just showed, but can you remember? I think it was in this period here, this move here in gold. Can you remember his tweet, Fire and Fury, when he was having his little spat with North Korea, and they were doing insults, you dotard, and that. This is, I can remember because I remember coloring this. This is the period of time he did the tweet about Fire and Fury and Rocket Man and all that jazz. So you can see that obviously gold rose quite dramatically at the pen. And again, this was really him fuel the fire of his tweets. So that's one example I know I can show, but there's probably so many, and maybe we'll do a special episode just on that at some point.
Maybe we'll do, yeah. And just to sort of draw a comparison where we stand, 1 week into the elections. I was looking at the charts earlier today. I see gold has traded sideways basically for the last month. So gold market's not taking any views what's going to happen. I think gold is being sort of in between of the inflationary and deflationary factors happening in the economy. And the same for US dollar. I mean, it's basically sideways. GXY was today 93. It's been 93, 95 since early October. We're going to have one webinar, by the way, on the 3rd of November, 2 p.m. Cyprus time, 7 p.m. Malaysian time. And we're going to talk about the policies of Donald Trump versus Joe Biden. And we're going to talk about how these policies may have an impact on US dollar, gold, maybe some other asset classes we're going to touch on. But we're going to go through these things basically in detail.
Absolutely. That'd be brilliant because, like I say, this is a big event. There's no hiding from it. This is a huge event which could present plenty of trading opportunities. And it's best to have a good understanding what this thing can have an impact on. Okie dokie. So that's going to be on the 3rd of November, yeah?
3rd of November. Yeah, we're going to do it early US hours because election is going to be in the evening. We're going to know results only on the 4th anyway, if we know the results on the 4th. Very important point. We may not have the results even on the 4th.
Yeah, that's a very, very, very valid point. So there we go. Make a note, 3rd of November, a very special webinar coming your way. Now, we do have some questions. Let me pull up the questions here we have. Give
my
me
favorite part.
You're always your favorite part. Of course it is. It's everybody's favorite part. Right. Question number one. I think you spoke about this a little bit earlier on. The question is, how do negative interest rates impact forex?
So yeah, we mentioned this earlier. Negative interest rates, the whole purpose is to weaken the currency. So what has happening for the last 10 years, there's a bit of currency wars, meaning those countries who export, they want to push their currencies lower. The easiest way to do that is to have negative interest rates. And they can always pack it in a way that, oh, we want to stimulate the local economy. Sure, yes, you want to do that, but you also want to push your currency lower. As an FX investor, you have to keep that in mind, that negative interest rates may have that effect that they're going to bring currency or depreciate the currency. But at the same time, looking at Japan and Switzerland, these two countries are the safe haven, right? So I don't think negative interest rates have actually decreased investors' appetite to invest in Japanese or Swiss assets.
I think again, we touched on this earlier on. It also depends on the country and the currency you're looking at. If, for example, you had a UK which had negative interest rates, that would be an impact, because that country is very much financial services driven. It's very much into the mortgage industry as well. They all buy their homes and things like that. So that has a different impetus. It's not so well known for manufacturing industry. So the fact that its currency is lower, it doesn't sell that many goods, so it won't affect it. So I think, again, it does depend on the country and the currency in question. The next question is, why do investors invest in countries with negative interest rates? It's a good question.
Already mentioned that as well. So, sometimes there's no other alternative. Let's say if we were coming up to this 2020 year, clearly the equity markets in US were overpriced, and you had all sorts of issues happening in Europe. Where are you going to put your capital? Investors are like, I want to put it to Switzerland. I think it's a country that will not default on anything. Swiss franc is always going to be safe haven. I'm going to invest in Switzerland. I'm going to buy whatever government bonds, and I'm just going to accept that negative return for the sake of preserving my capital.
Yeah, you're feeling more secure. At least your capital is going to be in a safe haven type spot. Okay, the next question is: given that inflation rate is so low in most countries, is inflation still an important factor?
It's still an important factor. And in fact, all central bankers are trying to get inflation slightly higher to avoid the trap of deflation, which we had on the slide. So deflation basically is negative inflation, and people perceive that the value of money will be more in the future. So they're going to postpone consumption. And what's going to happen is that velocity of money, meaning the circulation speed of money, is going to come down. You're not going to spend. Companies not going to have revenue. They can't pay to their people. They're going to lay off their workforce. So it's a very, very dangerous spiral. So all the central bankers are really trying to avoid deflation, and any inflation is good at this point. So very important data point. Will continue to be.
Absolutely. And another question is, what other economic data points should we keep an eye out for? Ones we maybe haven't already mentioned.
So on top of the ones we have mentioned, I would definitely, current account balance is important. I would always look at the country's debt levels, which, people tend to ignore, but I think it's very important for especially smaller markets. For those of you, for instance, who trade Turkish lira, Turkish lira is an interesting one. They have double deficits. They have the fiscal deficit. They have current account deficit, meaning they basically owe money to the entire world. And what has happened with Turkish lira? Historical levels. It has hit 8 versus USD. What would you look at, James?
Well, I could say, again, I mentioned briefly earlier on that it depends on what the market's sort of talking about, the sort of story it's focusing on. Average earnings, I always keep an eye on, because when you have like the jobless number, or NFP, the average earnings comes out at the same time, and it often gets overshadowed. But it depends on, I think, if the market is focusing on something, average earnings is important, because clearly, if you got inflation is rising and earnings aren't matching that inflation, then you're gonna have a problem in the medium to long term. So I looked at that. If if again I'm looking at maybe something like the euro, for example, and I have German data, industrial production would be another one. I tend to keep a very close eye on, understand, because I know it's an industrial nation, so it needs that to be a key thing there. But yeah, so average earnings in industrial production would be ones I would also keep an eye out for.
I'll just mention one more for the US. It's the housing. So
yes.
yeah. So clearly for US, again, the whole housing sector and all the services and goods that are tied to it and the employment that is tied to construction is a huge factor. So housing for US, the building permits, new house sales, existing home sales, which have all hit record highs, by the way, this month again. So important data point.
Absolutely right. No, I totally agree with that, because the US, again, is another nation which invests in property. And it buys a lot of properties.
That's where you put your capital, basically. You know, that's their golden egg.
Yeah, that's their nest egg, isn't it? Now, the final question: does news flow drive the markets, or do markets drive the news flow? Chicken and egg scenario. Very good one.
As much as I speak with market participants, it's still markets drive the news. The news are the narrative that are built around the markets. If you know, whenever some sort of movement happens on the markets, you have CNBC headlines, oh, this happened because of XYZ. Immediately they have a reason. They have a narrative. Human brain is designed in a way we need narrative. Something happens for a reason. So I think most participants would say that markets drive the news, but it can be the other way around. As we've just discussed today, we've proven the point today.
Absolutely. Brilliant. Well, thank you so much, everybody, for your questions. They're brilliant questions. And that is a wrap for our episode 2 of our Primus Live series. There you go. What do you think? Kaya, what do you reckon? How do you think it went?
Love the question and love the interaction. Definitely hope everyone's going to join for the 3rd of November webinar. We're going to do on elections. And then we are going to do a few of more of these with James about more technical analysis, about maybe fundamental factors. We'll see. And please feel free to share feedback. What are the topics you're going to hear about? More than happy to sort of take your ideas and put them in a video format.
Totally. Like I said, at the end of the day, guys, it is up to you to share your ideas. Let us know what topics you like us to cover, and we'll take the time to write the material and to make sure you're getting the education that not only you need, but the education you want, the areas of interest you're interested in. So on that note, thank you, Kaya, so much for your time today. Again, you've been an absolute star and a legend. And remember, guys, don't forget, 3rd of November, the very special webinar on a big event. What I'm talking about, it's a massive event happening, which is obviously the US elections. So all I have to say is goodbye from me and goodbye from Kaya. Kaya, do you want to say goodbye?
Thanks, everyone, for joining. We'll see you soon.
Brilliant. And remember, guys, this little live broadcast is for educational purposes only and should no way whatsoever be taken as advice. I always suggest you do your own research and do your own due diligence and know the risk at hand before entering any trade. Till next time, every single one of you, trade safe.